Foreign Earned Income Exclusion is worth up to $130,000 in tax-free income for Americans living abroad. For a married couple, it's worth up to $260,000 US combined. Now, every single year, thousands of Americans abroad accidentally disqualify themselves from it. Not because they're doing anything wrong on purpose, but because the rules have specific edge cases that most people never hear about. And a single miscounted day or wrong kind of income can cost you the entire exclusion. Today, I'm going to walk you through the 4 most common ways Americans lose the FEIE and exactly what to do to make sure it doesn't happen to you. I'm Vincenzo. I left Wall Street 15 years ago to live abroad, and I've been running an international tax firm ever since, helping Americans in over 150 countries claim the Foreign Earned Income Exclusion correctly. We see these exact disqualifications every single year, and almost all of them are preventable. 4 ways Americans lose the FEIE. 1 that most people know about, 2 that catch even the most experienced expats off guard, and 1 that's costing retirees tens and thousands of dollars a year without them realizing it. Mistake 1, miscounting the 330 days. 1 way to qualify for the Foreign Earned Income Exclusion is the physical presence test. Now, the physical presence test requires you to be physically outside the United States for at least 330 days in any 12-month period. Sounds simple. It isn't. Now, here's what disqualifies people. The day you leave the US doesn't count as a full day abroad. The day you arrive back doesn't count as one either. A 4-hour layover in JFK on your way from Madrid to Mexico City disqualifies you that entire day. Even if you left JFK Airport en route to Mexico City, the clock strikes midnight, and you are still in US airspace, boom, that qualifies for a day in the US. Now, time in international waters, like a cruise ship crossing the Atlantic, or the Nomad cruise, which shout out to them, it's an awesome cruise. But unfortunately, this time does not count as time in a foreign country. It actually counts as time in the US. The most common version of this mistake looks like this. A client thinks they had 340 days abroad. When we actually count the travel days, the layovers, the international water time, they had 328. 2 days short. Full foreign earned income disqualification for that 12-month window. Now, here's how to actually execute it. Track your days in a spreadsheet or an app all year long, not from memory in April. Count only the complete 24-hour days from midnight to midnight where you were physically in a foreign country. Know that you could pick any 12-month window, not just the calendar year. So if you moved abroad in June, then generally you want to use the June to June window, not the January to December window. Now, I always tell clients to leave a little cushion when they're planning for the year in case there are flight delays and cancellations. Now, that's the mistake that most people know about. The next 2 catch people off guard who thought that they were being careful. Mistake 2, earning the wrong kind of income. The FEIE only applies to earned income, money that you actually work for. Things like wages, salaries, self-employment income, professional fees. The FEIE does not apply to passive income. Dividends, interest, capital gain, rental income, pension distributions, Social Security. None of it qualifies, no matter how long you've been abroad, for how well you passed the physical presence test. This is the mistake that hits retirees the most. We've had clients move abroad thinking their pension income would be shielded by FEIE. It isn't. Their entire retirement remains fully taxable in the US. It also hits investors. A client moves abroad, has a strong year in the market, thinks their capital gains are protected. They aren't. Only the earned income qualifies. Now, here's how to think about it. If you had to actively work to generate the income, it probably qualifies. If the money came to you passively while you're sleeping, it probably doesn't. So for income the FEIE doesn't cover, the foreign tax credit is often the better tool. Now, even if your income qualifies and your days abroad are correct, there's a third mistake that people make once they decide to live abroad. That's mistake 3, not establishing a foreign tax home. So you qualify for the FEIE by one of 2 ways. You don't need to qualify both. It's only one or the other. So it's either being outside the US for the 330 days in a 365-day period, that's called the physical presence test, or the other test, which is the bona fide residence test, which according to the IRS means you establish your residence in a foreign country for an uninterrupted period that includes an entire tax year. Now, this one is subtle. It isn't a bright line test. In practice, we look at things like a long-term lease or home purchase, local immigration registration and a visa. If you're moving for work, it's an open-ended assignment with no fixed end date. Of course, if your family's relocating with you, having local bank accounts, community ties, even having local doctors helps. Now, here's how to get a bona fide residence. Have one country that you could point to as your primary base for the year. Sign a lease there, open a bank account. If you're self-employed, register your business or your work address there. Now, you don't have to spend your whole year in that one country, but you do have to be able to show that you spent significant time there and that your life, your personal and your professional life, has a center of gravity outside the US. So what's the benefit? You no longer need to count your days to be in the US under 35 days. Of course, you still need to live the majority of the time abroad, but being a bona fide resident of another country gives you the flexibility to be in the US up to 2-3 months out of the year. Now, one more caveat, any time that you actually spend physically working in the United States cannot be excluded under the FEIE. So you need to do that pro rata allocation. The last mistake is the one that costs people the most. And it's the one that happens years before anyone realizes. Mistake 4, revoking the FEIE without thinking it through. Now, once you claim the FEIE, you could also unclaim it. This is called revoking. Now, sometimes clients revoke it deliberately because they're moving from a low tax country to a high tax one, and the foreign tax credit sometimes becomes more valuable. And sometimes clients revoke it accidentally by filing incorrectly or claiming incompatible benefit. Now, here's the catch. Once you revoke, you cannot claim the FEIE for the next 5 years without formal IRS approval. That's up to $650,000 in exclusions over 5 years gone. We've had clients come to us in year 3 of a 5-year revocation lockout, having realized that they made the wrong call. And there's not much anyone could do at this point. So here's how to protect yourself. Don't revoke the FEIE without running a 5-year projection first. Know exactly which benefit works better for your specific income mix and your specific country before you switch, because you can't just quietly undo it. Now, here's what all 4 mistakes have in common. Every one of them is preventable with proper planning. Every one of them is expensive to fix after the fact. The FEIE is the single biggest tax break available to Americans abroad, but it only works if you plan around it, not if you just assume it applies. So if the FEIE is on your radar, there's a bigger question a lot of my clients ask right after this. What does the IRS actually do after you leave the US? Because there's a lot of noise online about it, and most of what you hear is wrong. The next video on the screen walks through what's actually true, what's outdated, and what's pure clickbait. Watch that one next. And if you want us to look at your specific situation, make sure your FEIE claim is set up correctly. The link below will get you a call with our team. Thank you.